All right, guys, welcome back for another video on momentum strategy. Before I get started, please make sure to subscribe to the channel and check out my video on stochastics and RSI if you haven't already. Also, check out the end of the video. I'm gonna read an article from a quantitative analysis firm to talk about the benefits of utilizing multiple uncorrelated momentum strategies. But let's just jump into this strategy right now. So essentially what I've done here is I have four exponential moving averages. You can just, on TradingView, just search exponential moving average. It'll come up. I'm using the 8, 13, 21, 34. For those of you who are familiar with Fibonacci numbers, you'd know that 8, 13, 21, and 34 are Fibonacci numbers in the Fibonacci sequence. That's why I've chosen them. I utilize the 618 retracement a lot in my trading. We're not going to talk about that in this video, but you know, just uh, just the rationale for why I chose these particular EMA numbers. And I have the higher periods, the 21 and the 34, marked off as purple, and the lower periods, the 8 and the 13, marked off in gold. And so this just gives you a pretty good idea of the momentum that exists in the market. When you see the lower periods cross below the higher periods, that's a sign that momentum is changing, right? So and that something's changing in the market that you want to pay attention to, right? Uh, here, so here on this weekly close, right? You did have a higher high on the weekly, but in the context of momentum that you see on the exponentials, you didn't see that cross up, which is in hindsight is very obvious. But at the time, if you were paying attention to this, you may have noticed that and said, okay, well, I just want to wait until the momentum crosses my favor. You see the same thing here, right? If you were to go down on a daily chart, right, this set a higher high here, and price runs up above it. But in the context of what momentum's doing, you get more pushes down for liquidity until the exponentials turn around, right? And this is at least in Bitcoin, it's much more effective to the upside just because of the nature of Bitcoin. So you really want to pay attention to that when it crosses to the upside, right? Or in other words, you don't want to stand in the way of upside momentum in Bitcoin. It does work to the downside. I mean, it clearly worked here, but if you back test it, you'll probably find that it's a little bit less effective than the upside. So you want to especially pay attention to the upside. You can see, just going back, it gave you a good frame of reference. Sometimes when there's like a black swan event, this I still hold to the idea that this probably would have played up if not for the black swan event. So you got to keep that in mind. Like, things happen, invalidate, but then it you get the black swan event, and then price reclaims the level, and then just steady uptrend. You can also see that here, right? So Bitcoin officially confirmed the bear market really when these momentum, the lower periods cross below the higher periods, and then you get your capitulation afterward, which I think is what people are kind of looking for now currently in the market. But on the other hand, right, people here were very bearish, and in this disbelief rally here, we're in disbelief. And then when the lower periods started climbing above the higher periods, that's really a sign to tell you, like, okay, momentum is actually to the upside. Doesn't matter how much resistance is above. I want to pay attention to that and trade into that. So let's go down to the daily, see what it's showing. Yeah, you can see it's very smooth here, right? It gets in this expansion of volatility, every test up into the higher period moving averages gave you a great sell. Of course, it's in hindsight, but you notice that you don't really want to ignore some of these signals. Even here, right, you get this consolidation of volatility, right? And you also have to understand what's going on in the context of the market, right? So here you're in a consolidation period, and consolidation periods are the periods where these EMA and momentum strategies are going to be the least effective because, well, the market's just consolidating. It's not trending, right? So you got to keep that in mind when you're trading a momentum strategy, because within a consolidation environment, a momentum strategy is going to give you a lot of signals that are essentially false signals, right? But so you have this consolidation period here, so marked by higher lows and essentially lower highs. right? This high is lower to that one's lower to that one, and then essentially you get, the break above, right? So price is exiting the consolidation period, and yeah, and then price, that's when, so it gave you a lot of signals here that, you want to discount within the context of the consolidation, but once it starts breaking the consolidation, that's when you want to play the momentum strategy. And again, it didn't really, give you a uber giga trade, but, hopefully maybe you took profit on that up here, hopefully, um, above these highs or something. But essentially, price crosses up here, price crosses down here. So even if you weren't to take any profit at all, you would have just scratched the trade. Hopefully you did take profit and manage equity on the account. Still would have been a profitable trade. Now let's go up here. Yeah, you can see here, it really helps you on the daily identify when the market's turning around, right? So you have this, apex formation here, and then price starts selling off, and the momentum's telling you that, it's changing around. And you really want to pay attention to it, because you can see here that, like, it gives you the signal before the momentum and the volatility really picks up, right? So if you're not paying attention to it, then you might be on the wrong side when the volatility picks up like this. And so it's just something to keep in mind. Again, here's a good example of how, it's less effective on Bitcoin to the downside, and much more effective to the upside. And that's just the nature of Bitcoin, right? It spends more time going to the upside, but uh, still you can, you know, uh, sometimes it gives you a little bit of decent trades to the downside, essentially. Especially when it's in line with a higher time trend. So if you see, like, if we're on the daily and you see the daily is crossing down, like right here, let's mark this off right here. So officially things start crossing down right there. So that's where you'd want to mark it off, because that's where your momentum indicator is telling you that the momentum's changing. And now let's use different time frame confluences within this idea. So let's see. Okay, so here's where things turned around on the daily chart. Now, it already turned around on the 4 hour, but within the context of the daily, you could take. So here is an example of where the 4 hour turned down in line with the daily, right? So maybe you enter here, didn't give you a huge move, but it did give you the opportunity to take profits below here. And here's kind of, and then it crosses again down in the line with the daily. And then that really gives you a nice move. And you can see every time here, basically you get a lot of good plays. Um, During my back testing on EMAs, I've actually, for whatever reason, noticed a very high degree of efficacy on the hourly chart. And it's actually in a more dynamic way than some of the higher time frames, which is a little bit unusual. Typically you see the higher time frames give a little bit higher of an edge for different strategies, but in this case, the hourly seems to have the highest playoff. Now, of course, you need to manage it dynamically, but it always gives you a little bit of edge to take out of the market. So let's just run through the hourly right here. So here you always want to play it in the context of the trend, right? So basically, since the prior FOMC meeting right here, we've had a pretty strong downtrend. So I wouldn't necessarily want to be playing the crosses up here. I want to understand the bigger time frame within the context of the hourly, and then use the hourly cross to fall in line with what's happening on the higher time frames. So I want to play the crosses down. So you can see, well, here really it was such a strong downtrend that you basically, it doesn't really recross at all, essentially. Um, but again, you get these movements up here, but the momentum's still down, pushes down. Then you get this V-shaped bottom right here. And even this cross here, right? If you were to enter here, it did give you an opportunity to take a scalp. Now you just need to manage it dynamically, right? So if you enter up here, you have a stop there. So even this trade, would have given you an opportunity to take profits out of the market if you entered there and took profit here. There's probably a price distinction at this level, and then you have a stop up here. Well, you took profit here, stopped it, broke even for the remainder of the position. You still pulled money out of the market. And that's, in my opinion, that's a really good sign of an edge when you really want to focus on the scenarios where it doesn't work out perfectly. And if those scenarios tend to scratch or give you the opportunity to exit the trade at break even, those are some of the best edges, really, because it allows you to manage your downside really well. And I think this edge falls into that category. Again, you can just see this pattern playing out, right? You get this cross down, price moves pretty dramatically. Even here, even these trends to the upside, you get a spike into there, move up. Again, on the hourly, it's not going to give you it's not going to give you a multi $10,000 move. But if you trade it in the direction of the high time frames, it will, and it'll give you a much better timing than the high time frames, because the high time frames tend to play out, but then when you get the lower time frames aligning with the high time frames, then it gives you a much better basis to when to expect a move and reduces your opportunity costs. Again, just running through these, you get this cross down, and then you get a spike up, probably a 618 retracement right there. Then you see, you get this cross up here, retrace down, spike up. This one's not very tradable right here. And sometimes it's not a great, basis for an actual entry of the trade, but sometimes, you can use it as a counter trade signal as well. So like, if you were basing a short off some of this area right here, and then price comes up into that region, stalls in that region, and then crosses up, well, that's kind of telling you, okay, you may be on the wrong side of this trade. Maybe it's time to tighten up your risk management parameters and, kind of at least take into consideration what the momentum is saying. Not necessarily, it's not always necessarily an entry or framing an entry. Sometimes you can use it for risk management as well. And here you see, a lot of times you'll get this signal, right? You'll get, when price forms an apex, what will happen is, on price action solely, you come back below this low, close below this low, and then you get an apex formation, and that's where things turn around. You don't necessarily need to look at the exponentials to know that, but the exponentials show you what's happening. So you get a price extension fill, and in this case pushes lower, drifts up into this area, sells off. Here's another good example. So sometimes when momentum expands, it doesn't necessarily give you a great entry. You may, this is a good example of where you don't necessarily get a great entry until this point right here, right? Because basing off price action principles, so price comes down, tests this level right here, these highs right here. The bodies of these highs are typically more responsive than the wicks, and you get that spike down, come up, and then you got the low here. You can use that. That's where price turns around. So there's your invalidation level. If you were long here, hopefully you're taking profit up there. And so you get the idea. So generally, here's a downside expansion. So within the context of that, right, you're going to want to trade the hourly when it expands to the downside. So we know we're in a high time frame trend right now. So we don't really want to play the hourly crosses that are crossing to the upside, right? We want to fall in line with what's going on in the high time frames, play the crosses to the downside. So price spikes up. This is probably a 618 retracement right here. Yeah, so you get your 618 retracement. So I don't want to be looking at this as support, right? Because of the context of what's going on in the higher time frames. So it comes up, fills the retracement, comes down, and then crosses down. So some people might be looking at this as support. But just, in the context of what's going on here, what you're seeing in momentum and what's going on in the higher time frames, you can, pretty much know that it's probably not going to operate as support. I mean, you do get a reaction off there, right? So uh, the people who are looking at this as support, probably have their stop losses below here. So you see price comes down, runs the stop losses, and then retraces into the momentum, sells off. Anyway, I hope you guys like this video. Please make sure to subscribe to the channel, like the video, and I'll be uploading more videos soon. So stay